Imagine waking up in 2027 with an extra $150,000 or even more in your portfolio, not because you got lucky with one hot stock, but because you followed a smart strategic plan throughout 2026. While most Americans are still stuck chasing yesterday's trends or panic selling during dips, the truly smart investors are quietly positioning themselves to capture the massive wealth being created by the AI boom. But here's the honest truth. If you keep doing the same old things, like blindly putting everything into a basic S&P 500 index fund without any adjustments, you might completely miss out on the biggest wealth transfer of this decade. Welcome everyone to your Advanced 2026-27 Wealth Playbook. In the next 10 minutes, I'm going to walk you through a complete, actionable strategy designed specifically for American investors who already have some experience and want real, meaningful results. We'll cover how to ride the AI growth wave, protect your money against rising risks, optimize your taxes in the current environment, and truly future-proof your retirement. This is not beginner-level advice like, just save more money. This is advanced, practical guidance you can start using right away. So let's dive in. First, let's get a clear picture of the 2026-27 economic reality. According to major forecasts from Morgan Stanley, Goldman Sachs, and others, the U.S. economy is expected to grow at a steady 2.2% to 2.6% in 2026, largely powered by massive AI infrastructure spending. Companies are pouring hundreds of billions, think $660 to $690 billion from just the top 5 tech giants like Microsoft, Amazon, Alphabet, Meta, and Oracle, into data centers, semiconductors, chips, power infrastructure, and AI software. This AI capital investment is the dominant force keeping the economy resilient despite other headwinds. However, it's not all smooth sailing. Energy prices remain elevated because of global tensions and supply constraints. Inflation is proving sticky, especially in services, and could hover around 2.4% to 2.9%. And recession risk is estimated between 25% and 35%, depending on how things play out with policy changes and energy shocks. However, the biggest winners will be those companies that actually turn AI hype into real earnings growth and expanding profit margins. Advanced investors need to focus on sectors that directly benefit from this AI power demand: semiconductors, utilities, industrials, and defense. Risks to watch include high valuations in tech, policy shifts, and energy shocks. Relying only on broad index investing may leave money on the table. Here's your core advanced portfolio blueprint for 2026-27. Start by allocating 40 to 50% of your growth portion to AI and productivity winners: U.S. large-cap tech, semiconductors, AI software, and data center companies. But don't just buy popular names. Choose companies showing strong, accelerating earnings from AI. Next, add 15 to 25% for diversification with international and emerging markets. Include 10 to 20% in alternatives like gold, infrastructure funds, quality bonds, and defense stocks. For income, use dividend aristocrats and covered call options. Practical tips: rebalance quarterly, use dollar cost averaging, keep 5 to 10% in cash for opportunities. The goal is resilience and compounding. Now let's talk about advanced tax moves. Consider Roth conversions if you're in a lower bracket. Max out 401k, HSA, and IRA. Do tax loss harvesting. High earners should explore real estate and opportunity zones. For those nearing retirement, stress test for 30+ years, build 6 to 12 months emergency fund, factor healthcare costs, and review debt for refinancing. Protection is crucial. Avoid overconcentration in AI stocks. Manage debt, build resilient skills. Psychology matters. Discipline beats timing. 2026-27 is full of promise and pressure. AI is creating enormous wealth, but only for those who act strategically. Implement even 3 strategies and you'll be far ahead. Review your portfolio this week. If you got value, like, subscribe, and comment. What's your biggest financial goal for 2026? This is for educational purposes only. Consult a fiduciary advisor. Stay disciplined and keep building your wealth. Housing affordability is still a challenge. Unemployment may drift higher toward 4.6% to 4.8%, and consumer sentiment is under pressure from everyday costs. This environment means it's not a simple, easy bull market for everyone. Instead, it's a stock pickers and smart allocators market, where the biggest winners will be those companies that actually turn AI hype into real earnings growth, higher productivity, and expanding profit margins. Advanced investors need to focus on sectors that directly benefit from this AI power demand. Think beyond just the obvious big tech names. Look at semiconductors, utilities that supply electricity to data centers, industrials involved in infrastructure build-out, and even defense stocks that could gain from ongoing geopolitical risks. Risks to watch closely include high valuations in some AI-related stocks, potential shifts in government policy, and sudden energy price spikes that could slow things down. The key takeaway? Relying only on broad index investing may leave money on the table. You need a more active, thoughtful allocation strategy. Here's your core advanced portfolio blueprint for 2026-27. Start by allocating 40 to 50% of your growth portion to AI and productivity winners. This includes U.S. large-cap tech leaders, semiconductor companies, AI software platforms, and firms building data center infrastructure. But don't just buy the most popular names everyone is talking about. Dig deeper and choose companies that are showing strong, accelerating earnings growth directly from AI adoption in their business models. Look for real revenue traction, not just promises. Next, build in 15 to 25% for diversification to protect yourself in this fragmented world. Add selective international stocks in emerging markets where valuations look more attractive compared to the U.S. Include 10 to 20% in alternatives like gold as an inflation hedge, infrastructure funds, quality bonds, and possibly some defense-related investments due to global uncertainties. For steady income in this high-valuation environment, focus on dividend aristocrats, companies with long histories of raising payouts. And consider using covered call option strategies on stocks you already own to generate extra yield without taking on too much extra risk. Here are some practical implementation tips to make this work. Rebalance your portfolio at least every quarter to stay on track. Use dollar cost averaging whenever volatility spikes to buy more shares at lower prices. Keep a flexible 5 to 10% in cash or short duration bonds so you can jump on opportunities when the market dips. This balanced approach gives you strong growth potential from AI while building in protection against sudden downturns. The ultimate goal is long-term resilience combined with the power of compounding over years. Now let's talk about the advanced tax optimization moves that can literally save you thousands of dollars this year and beyond. If you're currently in a lower tax bracket, seriously consider doing partial Roth conversions from your traditional IRA or 401k. This can help you pay taxes now at a lower rate and enjoy tax-free growth later, especially if you expect rates or your income to rise. Make sure you max out all your tax-advantaged accounts. Push the limits on your 401k, health savings account, HSA, and IRA contributions. In your taxable brokerage accounts, implement regular tax loss harvesting. Sell losing positions strategically during dips to offset gains and reduce your tax bill. If you're a high earner or have side businesses, explore real estate investments for depreciation benefits, qualified opportunity zones, or maximizing business deductions. These moves require some planning, but pay off big time. For those of you nearing or already in retirement, take time to stress test your entire plan, assuming you'll live 30 years or longer in retirement. Build or maintain a strong emergency fund of 6 to 12 months of expenses sitting in a high-yield savings account. Carefully factor in rising healthcare costs, which continue to climb, and look into long-term care insurance options if they fit your situation. Also, review any existing debt. If interest rates ease later in 2026 or 2027, refinancing could save you significant money each month. Protection is absolutely crucial in this environment. Avoid overconcentration risk by not putting too much of your money into just a handful of AI stocks, no matter how exciting they seem. Keep a close eye on your personal debt levels so they don't become a burden. At the same time, invest in building skills or creating side income streams that are more resilient to AI disruption. Things like personal services, creative work, or niche expertise. Most importantly, remember that psychology often determines success more than perfect timing. The investors who win are the ones who stick to their well-thought-out plan even when the market gets volatile. Discipline beats chasing headlines or trying to time the market every single time. To wrap this up, 2026-27 is a period full of both incredible promise from AI innovation and real pressures from economic challenges. Artificial intelligence is creating enormous amounts of new wealth, but that wealth will only go to those who take strategic, disciplined action instead of just hoping for the best. I challenge you to implement even just 3 of the strategies we discussed today. Whether it's adjusting your portfolio allocation, starting a Roth conversion, or setting up better tax harvesting, you'll quickly find yourself far ahead of most average investors. Take some time this week to review your current portfolio with fresh eyes. If you got value from this video, please hit the like button, subscribe to the channel for more advanced wealth strategies, and drop a comment below. What is your single biggest financial goal for the rest of 2026? I read every comment and love hearing from you. Remember, this video is for educational and informational purposes only. It is not personalized financial advice. Always consult with a qualified fiduciary advisor who understands your specific situation before making any changes. Stay informed, stay disciplined, and keep building your wealth the smart way. I'll see you in the next video.